Did you know that Parent Plus loans are eligible for public service loan forgiveness? You may not realize that Parent Plus loans, which are taken out in the parents' names only, can also be eligible for the program. You may be familiar with the program for your own loans, for example, direct Stafford loans, which are taken out in your name, or some of the unsubsidized loans and the direct plus loans that are taken out in the student's name when they go to grad school, law school, or med school. But for Parent Plus loans, those can be consolidated into loans, which are then eligible for public service loan forgiveness. There are some different criteria that we're going to discuss today that you need to be aware of, and some differences in the repayment plans that are eligible for borrowers that take out loans in their own name and for Parent Plus loans. What's up, everybody? I'm Danny Sinowitz, the College Dude. So when it comes to Parent Plus loans, we did a video previously which discussed who should be considering taking out Plus loans, how they work, some of the pros, some of the cons, but a brief refresher on Parent Plus loans. They're taken out in the parent's name only, and they're eligible to dependent students, which 99% of the time is going to be students who are in their first 4 years of undergrad, and they're the students that typically will come out of high school going directly to college. Parents are able to take out Parent Plus loans to help cover that cost for the student, and those loans again are going to be in the parent's name only. However, since they are direct loans, they're offered through the Department of Education, they can then be put into a consolidated loan, and then that consolidated loan can then be eligible for public service loan forgiveness. So the Public Service Loan Forgiveness is a great program. It was established in the fourth quarter of 2007, and that program allowed individuals who are working in the public sector, which can be a fairly broad definition, but you can check the Department of Education website to determine who exactly is that person who's eligible or who can be eligible to be considered a public service employee. But that public service loan forgiveness allowed those individuals who were enrolled to have their loans completely forgiven after 120 qualifying payments, which amounts to 10 years of public service. They've made some revamps to that, and when it first came out in 2007, and then the first forgiveness eligibility folks started to take place in 2017, it was very messy. It was not a clean process, and unfortunately, it got a bad rap at first. But since we're about 6-7 years in now, it's been cleaned up, and there have been people that have found the Public Service Loan Forgiveness Program has been a beneficial one for them. So when it comes to Parent Plus loans, though, you need to make sure that if you consolidate that loan, that you're in the right repayment plan to be eligible for Public Service Loan Forgiveness. So that repayment program that you want to be placed into is the Income Contingent Repayment Plan. It's the only repayment plan that you're eligible to be going into as a parent, as having a Parent Plus loan that can be consolidated and then repaid upon. We're going to go through a couple case studies and examples to show what exactly that looks like. But there used to be a loophole or a bending in the rules, if you want to call it that, called the double consolidation plan. That is going to be taken away as of 2025, the year 2025, which would have allowed Parent Plus loans to be consolidated into nearly any of the repayment plans. But that option, unfortunately, is going to be taken away starting in 2025. So what we want to focus on is the Income Contingent Repayment Plan, specifically for borrowers who are just stepping into college right now that are starting to take out Parent Plus loans. So 2 quick case studies. The first one that we're going to look at is a married couple. The spouse 1 is going to have an income of about $50,000. Spouse 2 is going to have an income of $100,000. Spouse 1 is going to be the public employee, and they're the ones that are going to take out the Public Service Loan Forgiveness in their names. We're going to show you the calculator and how it works, but the things that you want to be aware of is what they're going to take into account is household size, and the Department of Education on the repayment plan is going to take into account the income that you have. So you're going to need to recertify your income and your household size each and every year. But what can end up happening is if depending on the way that you file your taxes, married filing jointly would consider both incomes, But if you file married filing separately, that could drastically lower the payment in the income contingent repayment plan. And again, we'll show an example of how exactly that works. What you really want to be aware of, though, is there are other benefits, as I'm sure you found, to being married when it comes to your taxes. Taxable liability as a married filing jointly couple is a lot different than it is if you're married filing separately. For example, you cannot contribute to a Roth IRA if you're married filing separately. You're not eligible for certain tax credits like the American Opportunity Tax Credit if you're married filing separately. So you want to make sure that if you choose that married filing separately tax filing status, that it doesn't take away from other benefits that you're currently using if you're married filing jointly. Between the two, it's something that is going to be very important between the repayment plan and the other tax benefits that you definitely want to consult your accountant, a tax professional, your financial planner on. Let's get on to the case study here and see how it would work, and we'll show you the calculator, a brief description of what it looks like. All right, so you're going to see here that we are in the income contingent repayment calculator on savingforcollege.com. So the way that this works is you want to fill out all your personal information, and I went ahead and pre-populated it. Some of the quick facts: we're going to say that we are married. Household income in our example is $150,000. We're in the continental United States. The average income growth rate is 5%, family size of 5. Tax year that we're using is 2020, and we're saying that we're married filing jointly. We're applying for the public service loan forgiveness, and the total student loan balance we're going to use is $100,000. We're saying an 8% average interest rate on that $100,000, which again will vary, but right now we'll use 8%. We're saying it is unsubsidized interest, and the inflation rate is 4%. When you calculate, you'll be able to see here how much you'll be able to get. So the first month's payment, if you go on the standard repayment plan, is $12, $13, $28. If you go on the income contingent repayment plan, it's almost $2,000. So you're paying more in the income contingent plan than you would be in the original. The total payments that you see here are going to be slightly less in the income contingent plan, but it's $2,000 a month. That's well over what a lot of people's mortgages are. So instead, what you then want to look at is seeing, can you do a different option? And we'll show you what that looks like here in just a second. In this example, the only thing that we're going to be changing is the married filing separately status, and therefore it's going to be $50,000 that we're going to use for household income. Everything else is going to remain exactly the same. We're still applying for the public service loan forgiveness at the same levels here. So if we calculate this, you're going to see that there is actually a pretty significant difference here. The first month's payment is going to be $322 compared to the $1,213. If we look down here, the last month's payment is also going to be quite different. Total payments, you can see, is almost a difference of $100,000, and you're eligible for almost $150,000 of total forgiveness when it comes to the balance that you'll be paying. Remember, if this is public service loan forgiveness, that is not a taxable amount. After 10 years, that's what can end up happening if you choose the ICR route. The second case study that we'll look at is a single parent who is working in a public service loan forgiveness eligible job, and that family and that they have right there, the parent makes $100,000. So we'll compare to see what that looks like for a single earner making $100,000 compared to the married couple who's looking to either file married filing jointly or looking to file married filing separately. In this example, we're just changing things up a little bit. We're saying that the family is not married, that it's $100,000 of household income, and again, taking the family size down by 1. Our tax filing status is single. Everything else is remaining the same. When we calculate it, you're going to see here again, public service loan forgiveness is very, very unlikely in the circumstance that that's how much you're currently making. When it comes to this program, the public service loan forgiveness program and the Parent Plus loans, you want to make sure that you have a plan to repay these loans. Again, to recap, what you want to make sure of is that if you're married filing separately, that it doesn't take away from all the other tax benefits if you choose the married filing jointly route. It really is only going to be a fit for certain families and certain individuals that can take advantage of this program. For individuals who are making high incomes in a public service position, it may or may not make a lot of sense to try for that public service loan forgiveness. But in the case where you have a married couple and the one couple who takes the loans out working in a job in which they're eligible for that public service loan forgiveness, it can be a real benefit and it can be something that you can plan towards. As always, you want to make sure that you take this information and specific to your situation, you consult your tax attorney, tax advisor, financial planner. You make sure that you take your specific situation and you can utilize this information and talk back to them to make sure that it makes sense for your situation. This is completely educational and general in nature and should not be taken as any specific advice. For more information on this, on the public service loan forgiveness, Parent Plus loans, and paying for college in general, please be sure to like this page, share it, and subscribe to my channel that you can get up-to-date information when it comes to paying for college. Take care. We'll catch you next time.